Ladies and gentlemen, welcome back to Talking Numbers. It's our Investment Plus podcast series, and we hope you've enjoyed the first 3 episodes as we spoke about retirement, we spoke about self-managed super funds, and we spoke about the importance of protecting your assets in the first 3 episodes. If you're joining us for the first time, you do have the ability to go back and have a listen to all 3 of those episodes. My name is Paul Jantz, and we hope you're enjoying our Talking Numbers Investment Plus series, brought to you by Virtual Financial, making financial advice affordable to all Australians. And that's been a really important tagline that Adam and I have spoken about in these first 3 episodes. Adem Becirevic, the CEO and founder of Virtual Financial. Welcome back to Talking Numbers, mate. How are you?
Excellent, mate. Thanks, Paul.
It's good. Good to have you back. It's been a good little series so far, hasn't it?
Yeah, it's been fantastic. Really appreciate it.
Yeah, good stuff, mate. Before we kick into episode 4, maybe let's do a bit of a recap of episode 3, where we spoke about, I suppose, asset protection, or we spoke about, well, let's go back for the first 3. Maybe you can give us a bit of some key points to look about that we spoke about, whether it be retirement, super, or asset protection. What's your top 3 things to remember?
Oh, look, I think the number one thing is to get advice. I think whether it's through Virtual Financial or anywhere else, I think you just need to get advice. The second thing would be to ensure you know, as I said before, take that day, one day a year to work on you. You know, our strapline is starts with you, so you need to make an effort and you know, really take that. Look at your financial well-being, look at your insurances, look at your super plan, speak to your lawyer about your will, speak to your loan broker about your loan, speak to your accountant about your tax. You know, it starts with you. Take that one day off and make sure you do that.
Brilliant. And I could not have wrapped that up anymore. So again, if you need to rewind this and go back to what Adam just mentioned in that 30 seconds about it starts with you to go and have those time with all those professionals, please do it. It's so important. Mate, we're going to talk about superannuation in this episode and the options that are available. We know in terms of our superannuation, we've seen another spike from the 1st of July in terms of employer contributions from 10% to 10.5%, which is a part of our, you know, it's a part of our earnings, it's a part of our salary, it's a part of our asset that we continue to take away. So let's talk about the different type of funds that are out there. And again, from your point of view, some of the key things from our key assets, planning for retirement, you know, both topics we've covered earlier in earlier episodes. Let's talk about the options that are available to all Australians. What are they?
I suppose the number one option for all Australians is corporate super. It used to be huge, you know, 5-10 years ago with all the big players, you know, like AMP and Macquarie and Colonial. They all had corporate super. However, corporate super is great in the sense that you got automatic insurance with that. So that was great in a sense that if I know of one client where they had corporate super, they were able to join that. They joined a big company, got the AMP corporate super, diagnosed with a very bad illness 12 months down the track and got to pay $800,000. So corporate super is great for getting insurances if you're not too well. However, the government were, you know, thinking they're being very clever, took all fees away from corporate super. So basically a financial advisor can't charge a fee, AMP can't charge a fee, Macquarie can't charge a fee. So guess what? Corporate super now is basically corporate super. Very low fees, but again, you know, as I've said before, low fees isn't the answer to everything. So corporate super now really, I mean, I knew some great people in corporate super. We used to use AMP corporate super ourselves. In my opinion, we're the best in the market. But now, you know, with what's happened in the market, unfortunately, with no fees, obviously, you know, no one wants to look after corporate super because you're not getting paid for it. So there's no advice. So there's no advice. We had some big corporate accounts. We now just don't look after them. They now have a phone number. They ring AMP, and if they get some help, they do. If they don't, they don't. You know, so it's very sad. So corporate super is very big. However, I wouldn't recommend it unless you really need some insurances. Then it can become quite awful. And then obviously we then got industry super, which is very big in Australia, run by the unions and so forth, where they really push the industry flag, where like BusQ and all the industries where they might have building and so forth. So they some of these companies use these super funds to fund all their investments and their developments. So how good that is and how safe that is, I'm not sure, but that's kind of your industry model. But again, you've just got really phone advice. If you want to see an advisor, good luck. Like I know, they advertise it themselves. Australian Retirement Trust basically have 2 million members, and I don't know exactly how many, but I think they only have 100 or 200 advisors. So they don't have a lot of advisors working for 2 million members. And anyone I know that's been with that fund, and I asked them, have you ever got a phone call or an email? Never got any advice. So industry funds, again, obviously they push the low fees, but how low those fees are when you kind of see all the advertising on every sporting ground in the country. How's that being paid? It's being paid by people's super balances. And then, so we've got corporate super, we've got industry super, then we've got retail super, which is a common one. So retail super is what we use a lot for our clients. So we use BT Panorama, which in my opinion is the best fund as in platform on the market. They spent over $1.3 billion developing this platform.
Wow.
And it's terrific. However, obviously what goes into that platform is what we do. So as an advisor, we select our portfolios for our clients and make sure they go into the right portfolio, and that's really important. So retail super can be very very good for clients, especially clients that don't want to do a self-managed super fund. And obviously the fourth one is self-managed super. For our clients with higher balances and that want to maybe have a bit more of a say in their super, want to buy a property, want more diversification, want to have more control. So they're kind of the four areas of super that we commonly see.
Okay, interesting. So and you mentioned BT before. Like I'm pretty sure mine's a Macquarie Wrap. So that's known as a retail fund.
Yeah, correct. Yeah, so Macquarie Wrap's a retail fund as well. Yep. So
okay.
And BT, which is Westpac, is a retail fund as well. Yep.
Okay, good. So corporate, industrial, retail. What's the main differences between, let's say, and I know you mentioned it's a funny thing as well, because I'm in a retail fund, obviously, because I mentioned Macquarie, but I wasn't 100% sure just then. But then you do see, and again, we've spoken about these in previous episodes of this particular series, and the ads that sort of get you thinking about, should I join an industry fund? So what are the differences between, let's say, an industry and a retail?
Yeah, it's a very good question. I mean, I could be here all day, but just to summarise it,
yeah,
to keep it nice and clear for our listeners, is basically an industry fund is run for the members, and most of the part they do a good job. However, the biggest problem is you don't get any advice, and they have restricted insurances, so they don't have things like trauma cover. And a lot of industry funds, they have limits. I saw one the other day, and they're in their late 50s, and their life cover was down to $80,000 each. And because what this industry fund did, basically they had $500,000 or $600,000 10 years ago, but every year as they get older, the industry fund, to protect their own assets, they reduce the insurance down, right? So that's not the insurance we do. So when we put we put that $600,000 in place for our clients, they would still have $600,000 today. So industry funds potentially don't have like income cover. They might only have a 2-year benefit period, whereas that's good for 2 years, but you really need to have it to age 65. So there's just a lot of restrictions in regards to having an industry fund versus a retail fund. In my opinion, you're better off getting advice and having a lot wider choice in regards to investments as well. So a retail fund has a lot more choice in regards to how we can invest your funds. So with our retail fund with BT, we have a risk-adjusted portfolio. So we ensure that the portfolio isn't just in shares or isn't just in one asset class. So we have our portfolio that's in shares, it's in property, it's in fixed interest, alternative assets. We design a portfolio for our clients. We don't just plonk them into something. with two other million members and say, good luck, hope it goes well. We designed the portfolio. That's the difference. We designed the portfolio for our clients. We don't get thrown into a pool. And as you know, if you have a massive pool, it's very hard to move assets around when you've got billions of dollars of assets. You can't just switch here and there. Whereas when you're a smaller player, we can certainly do that.
Yeah, and I think you like you sort of mentioned before the industry funds where obviously the building industry, and it's taken a bit of a rocking over the last probably 7-8 months now. But you're right, they've got a lot of members that contribute to that, and then they go and build their own high rises. If you go into the cities and you see that they're actually, you sort of mentioned one of them before, sort of some of the building superannuation funds, they're building their own. Yeah, exactly. So they're using the funds to fund those in the future, are they? That's what they're doing.
Look, the reason why we don't invest any of our clients' funds in industry funds, because that's a question I get asked by a lot of people. It's quite simple. Besides the insurance problems and the investment issues, is that our group has written to industry funds asking them what assets they have, what liabilities do they have, what debt do they have. Please show us a balance sheet. They basically write back and say, get stuffed.
Right.
So there's no full disclosure there. So we don't know, like investing 101 when you're an investment manager is you don't want to be investing in a company that is highly geared. That has 70, 80% gearing. So, for example, the property companies we invest in have around 10% gearing. So we know they're never going to go.
Less risk,
right? So, but when we write to any of the industry funds, not just BusQ, you won't know that answer. You won't know how much they're borrowing, how much they're gearing. You don't know what the value of the asset is because they don't have to value it, which I think is one thing that I can't get my head around. I think it should have to be valued every year for the fund. But again, we're talking industry funds and unions and politics. There's some big hitters there.
Yeah, well, that's exactly right. It all comes down to power, doesn't it? You sometimes think, mate. With regards to, we spoke about employer contributions just before, and they've sort of gone up by 0.5% from 1 July, 10.5%. Why would an individual choose to contribute over and above that? So you got your employer contribution, and then we can contribute as employees as well, can't we? But why would someone choose to do that?
Yeah, well, you've got salary sacrifice and you do it yourself. I mean, one great change to the law that the government did make was you can actually make contributions into super now yourself. You don't need to do it through salary sacrifice. Obviously, you can. That's great. But if you want to, you can actually make a contribution yourself. So in the past, if you, had wages of more than 10%, you couldn't do it. It's only if you're self-employed. But the government made that change, which is, again, government have made some good changes. This is one where you can now make contribution in your super. So a lot of our clients, we train them up on our BT site. They can easily make a contribution into BT at any time online, very simple. And basically that then is a tax deduction. So up to 20, so you contribute up to $27,500 into super. So let's just say, you're on $100,000 a year, $10,500 will go into super. You still have a balance there of 17,000 that you could put into super. So you can make extra contributions either via salary sacrifice, or you can just do it yourself. And then if you say you put $1,000 into super, you can then claim that $1,000 in your tax return. So that's really encouraging our clients, and we encourage our clients to try and, when we're doing their retirement planning, is to, if they can get their super contributions up to 15%. It makes a massive difference to their retirement outcome, and we show them that in the planning. And once they see that, they're pretty keen to increase it to 15%. Look, a lot of government departments do that already, but
yeah, they do, don't they?
But people that work, for private industry and so forth, they don't.
Yes.
So again, it starts with you. You've got to make the effort yourself to do it.
So as an example, you spoke about salary sacrifice before, so that's pre-tax. And if you then and then if you chose to do that, let's call it with post-tax dollars that you've got sitting in your savings account, you can contribute that, but still get the tax deduction.
Correct. Yeah. So it's the same thing. It works out the same way.
I didn't know that. That's actually okay. Good to know.
Yeah, so it's a great change the government made. So now you can just go if let's just say you got a windfall of $10,000 or something, or you've got an inheritance or something. You can just go, okay, well I've got a spare $10,000, and my employer's only paid in $10,000, so I've got that gap there. I can whack the $10,000 into super, get a tax deduction, and boost my super by 8,500 because obviously the government take 15% of contributions that go in.
Yes.
Right. So you've increased your super balance by 8,500 after tax.
And can you do that consecutively every year?
Yeah, every year. Yeah,
every year. Okay.
Every year. And the interesting thing is also, while we're talking about contributions, is the government have also brought in, it's mainly for self-employed people, but it can be for anybody, in regards to putting contributions in over prior years from the year 2020 onwards. So, for example, 2020, 21, 22. So if we just use the example, let's say you've put in X amount per year into super, say 10 grand a year into super, and you've got a balance threshold there over the 3 years of another 10 grand a year, or let's call it 15 grand a year, an extra $45,000 a year. You could actually, in one hit, put $45,000 into super, get a tax deduction, and it could go into your super account. So it's called a five-year rate. Sorry.
So Adam, really, really interesting thought process there, because as we mentioned there, so you can basically put in the additional, I think you said $45,000, and you get a $45,000 tax deduction for that at the same time. So just some, again, just the information that sometimes what you don't know, and I mentioned this in previous episodes as well. So it's fantastic to all of you guys listening to this, that you've got the ability to do that and get the tax deduction with, like Adam said, whether it's an inheritance or you've had a bit of a windfall or whatever it may be, to go and top up that superannuation. So absolutely brilliant.
And the idea of that is going to be over a 5-year period. So as the years go on, it'll actually be 5 years. So any 5 years you can go back and top up your super. It's especially designed for self-employed people that don't have super, a lot of money lying around for say 5 years. Then all of a sudden, they can go 25. Well, the amount's 27,500 now. So times by 5, it gives you a pretty good deduction. So if you're earning a couple $100,000 a year, you can basically wipe out your tax bill and get all your money into super. So again, it's what you don't know is what you don't know. And unfortunately, these sort of things the government don't want you to know, because it again affects their revenue. So that again, that's why you need to get advice.
Yes, 100% in terms of getting the advice is so true, because you're right. The ability to self-employed people, this is probably the being self-employed myself and had my own businesses now for such a long time. Your businesses tends to be what you believe is your superannuation, because that's why you're building the business up. That's your asset. That's of value. But at the same time, you sell that, or you can bring in a partner. You get a bit of a windfall. You can top that up, which I think is outstanding. And as you said before, the key to getting advice at the end of the day, and why you're making it affordable for all Australians to get advice. So outstanding. Mate, is there a reason why someone would, we spoke about retail versus industry before. Is there a reason why someone would shift?
Look, I think the main reason would be to get advice, because industry funds, you're not going to get advice, or very limited advice. A retail fund, obviously, that's where you have a financial plan. You have a financial planner attached to that fund, and that's where you can hopefully get advice and get the right advice moving forward. So, most of our clients are in retail super, as well as self and super fund super. But we certainly the main reason really is to get the right advice, and also the right product, and the right insurances, and just being able to have someone. I think that the key thing for my clients is, they have my mobile phone number, they have my email, they can contact me anytime, whenever, if the markets move or they're worried, we can kind of quickly jump on a call, and I can explain to them, let's not forget the plan. This is what we're going to do. This is long term. Once they go back to our plan, they see what we're doing, how it's tracking, it's all on track. They certainly can then sleep at night. I mean, I had a client the other day, and she said she'd been in the industry fund for years, worried all her life about being able to retire on time, never got any advice. She come and saw me within an hour. She said, you know what, I can actually sleep at night now. knowing that I'm actually going to be a retire okay. She said, I've been worried for so many years. I don't know why no one's ever told me this before. And I said, I don't either.
Yeah, it's a great question, isn't it? It's a great question. And, what a great way to wrap up episode 4 of this particular 6-part series of Talking Numbers, Investment Plus. And I think the underlying key thing that to all of you that are listening to this is get advice and make sure that you are, again, if you don't have a financial advisor, go out and just find Adam, find him on LinkedIn, find him. Is that the best place to find you, mate, or through the website?
Yeah, website or LinkedIn's excellent, yeah.
Yep. Find him, and that's the great part about just, again, chatting to someone and start that conversation about the key things. Go online, check out the 5-minute health check. Again, it's free. So you got nothing to lose by sitting down and doing this, whether you're doing it as an individual, whether you're doing this as a partnership with your husband, wife, partner. Do it, because that's what's going to give you the ability to sit down and have a better conversation, because the 5-minute health check is a self-assessment. It's not about somebody telling you what you should do. It's about you assessing yourself to where you are today and maybe where you want to be in the future. And that's No, go, man.
Yeah, one thing I would add is that, everyone has a super fund. So, getting back to that one day a year, take the effort to look at what it starts with you. Make the effort to just know what you've got. Most people, I ask them about how much you've got in super. They say, I don't know. Where's your funds invested? I don't know. They're questions you should know off the back of your hand. If you don't know the answer to those 2 questions, you really need to take a day off very soon and get yourself sorted, because you need to know how much you've got in super, whether it's going to last you in retirement, and where your funds are invested. You should know that. You should be able to say, yeah, I've got 140 grand in super. I'm a growth investor, and everything's on track. If you can't say those 3 things, well, then you need to get advice. You need to make the effort, because it starts with you. And ring up your industry fund, ring up your retail fund, and say, hey, what's my log-on code? How am I investing? I mean, I've picked up clients in the past where, for the last 10, 20 years, if you can believe this or not, they've been investing in cash. And
God,
and because they've never asked the question, they've never made the effort. And
yes.
if they would have been even in the industry growth fund, they would have had triple the money they would have had once they've seen me. So again, as our strap line is, it starts with you. You've got to make an effort. Be brave and make the effort.
Yeah, and I'm going out on a limb here, but I think 99% of people would not know what you just asked there in terms of their super balance, what phase it's in, and where is it invested. So these are the things that you've got to, again, this is where you've got to step up to the plate and just use the information that's around you and the education like we're providing now to just start asking better questions, and therefore you'll have a better feel for where you are right now, and that's an important part. Adam, fantastic! Another great episode of our Talking Numbers Investment Plus series, mate. What's next for our episode 5 of our Series 1? What are we talking about next?
Sorry, mate, I haven't got it in front of me. Because I moved. I've got nothing in front of me.
All good. Let me cover it. We're going to be talking about investments. So The key thing, we're going to talk about properties versus shares versus crypto. Now, I think in one of the previous episodes when we talked about asset protection, we touched on crypto, and I think the volatility of crypto is interesting. But there are some options that I know that we've spoken about in the past that we will go into a little bit more detail. So stay tuned. Look out for our next episode. It is episode 5, where we'll have a look at property versus shares versus crypto, and it's going to be fantastic. Adam, thank you. I don't know if you've got any parting comments, mate, but you've given a lot of advice, general advice on certain things. But if you've got any parting comments, what are they?
Thanks, Paul. Well, look, I think, as I said before, just it starts with you. Be brave, make the effort. Be different. Don't follow everyone else and do nothing. Think of yourself. You want to be the 1%er. It's like me when I ran the marathon this year. I wanted to be a 1%er. 1% of people run marathons. You know what? Only probably 5 to 10% of people know the answers to those questions. So why don't you become one of those 5 to 10% of people that actually take an interest in their own financial affairs? Because financial certainty starts with you.
Brilliant, mate. Great way to wrap up. Thanks again for joining me, mate. To all of you that have joined us again, our loyal listeners, we hope that we've been able to bring you one or two or three key areas. I call them golden nuggets that you can actually go back and start reviewing. I think that's the beauty of this Talking Numbers series, or our Talking Numbers Investment Plus series, is just to provide information, provide education, and that's what we're about here at Professional Partners. So hopefully you've enjoyed it. Look out for our next episode, episode 5 of Series 1, where we're going to talk about property versus shares versus crypto. Thanks, and enjoy the rest of your day.
Thanks, mate.